Hi, I'm Jimmy. In this video, I'm going to walk through the truth about dividends, how they actually work, and if they are truly a good thing for investors. And if they are a good thing, which dividend stocks are the best. So at the most basic level, a dividend is when a company pays a piece of their earnings to shareholders. Now, there are a few different types of dividends, like cash dividends or stock dividends. In this video, I'm going to focus on cash dividends. So many investors love dividends, and it's completely understandable why. As I've seen commented in many different videos, some of my videos and some other dividend-related videos, that dividends are like free money. But are they really? And clearly, since I'm leading this video with that topic, I can safely say that dividends are not free money. Let me illustrate. So here's an actual example of a real company. This company is called Warrior Met Coal. Now, they provide coal mining services. And as we can see, the stock is trading at about the $30 to $33 range. Now, what's interesting is right about here, this $30 stock paid a fairly large dividend relative to the price of their stock. Their dividend was about $4.41 when their stock went ex-dividend on May 3rd. Now, if we were to look at this chart from that perspective, then maybe we say, wow, if we own this stock before that date, then we would have received that dividend. Now, let's pretend that we had bought this stock the day before the ex-dividend date. That way we do get the dividend. So we pay about $33 a share, and then the stock dividend goes ex the next day, and that's for $4.41. They knew the dividend was coming. We had plenty of notice. They notified us of that dividend at the end of April. So if we had done some quick math on the day that we bought the dividend, well, we say, okay, we're going to pay $33 a share, and then we're going to get a cash dividend of $4.41. And just like that, we're up more than 13%. Sure, in hindsight, the stock has drifted a little bit lower, but either way, because the dividend was so enormous, we still look like we're doing fairly well. But as you might have guessed, it doesn't actually work this way. Yes, on May 3rd, they really had their ex-dividend date, and their cash dividend was really $4.41. But the price chart, well, this is the dividend price adjusted chart. Now, this green line, this is the way the chart actually worked out. Now, this is the truth about dividends. Yes, dividends are awesome. And personally, I'm a huge fan of dividends, and I'll tell you why in a second. But dividends are not free money. See, this isn't unusual. This is the way it actually works. Not just for this stock, but for all stocks. On the ex-dividend date, the price of that stock will be reduced by the stock exchange that that company trades on. It will be reduced by the amount of the dividend. So in this case, the dividend was relatively large, so we can see a fairly large drop-off. That's why I chose this example to illustrate how it actually works, but it works the same for all companies. The price of the stock gets reduced by the stock exchange that it's trading on in order to compensate for the fact that the dividend was paid. If we've ever wondered why they call this the ex-dividend date, well, this is exactly why. On the ex-dividend date, the stock will trade without the value of the dividend in the stock price. Hence the term X. Yes, this also means that we need to own the stock before the X date in order to be eligible for the dividend. But on the ex-dividend date, the stock will trade without the value of that dividend in the stock price. And if we think about it, this actually makes a lot of sense. Dividends are essentially a transfer of wealth, not a creation of wealth. In this example, well, this company had $4.41 in cash per share on their balance sheet. They moved that from their balance sheet over to our brokerage accounts. So it is simply a way to move cash from their account to our account. All it does is changes who controls the cash. It doesn't actually create any new value. Now that actually brings us to a different negative of dividends, and that is that when they transfer that cash from their account to our account, we get taxed on that income. So does this mean that dividends offer no real value? Well, that's not the case at all. See, many people live off of the consistent dividends that they get paid on the stock holdings that they have. And although dividends are taxed, if we hold a stock for long enough, well, many of those dividends will become qualified dividends, which get taxed at a significantly better rate than unqualified dividends. But the real perk to dividends and dividend investing in general is that investors love dividends. Now, I was curious how good dividend stocks do relative to non-dividend paying stocks, and which dividend stocks do the best, and could we possibly understand why, and maybe we could use the information from that to try to make better investment decisions. So here's a chart that I created based on a backtest that I did. And basically what I did is I took the S&P 500 and I broke it into 4 different categories. I took the top quarter of all S&P 500 stocks ranked according to dividend yield, and I took the top quarter of them, grouped them together. Then I took the next quarter, and I grouped all those together. Then the third quarter, grouped all those together. And then the final one was I took whatever stocks had a 0% dividend yield. This is their performance over the past 20 years. So we can see that our top performing group was in fact the second 25%, which means that it wasn't the highest dividend yielding stocks in the S&P 500, it was the second quartile of them. Although the highest dividend yielding stocks, the purple line, they're the top 25%, well, they came in a close second. And then the third highest dividend yielding stocks, and then finally, in fourth place, the 0% yielders. Then I began to wonder, was this pattern true through different time periods, or was this 20-year time period just a coincidence? So then I shortened up the time period from 20 years down to 10 years. And as we can see, the second highest dividend paying stocks were once again vying for the top spot, except for this time, they were fighting with the 0% dividend payers. Then, if we have the top dividend payers, they're the purple bar, well, they're not too far behind either. And then trailing the whole group, similar to the last time, was the third highest dividend paying stocks. Or in reality, they're actually the lowest dividend paying stocks out of the S&P 500 companies. But let's not stop there. What about 5 years? So when we shorten it to 5 years, just like the 10-year period, the 0% group and the second highest dividend paying stocks, they're doing the best. While the top dividend paying stocks in purple, they're vying for third place. And then in last, once again, is the bottom quartile or the lowest dividend paying stocks. So first, let's look at why the results would end up like this. Then we can look at how each category is broken down by dividend yield. And then perhaps we can use that information to try to help our portfolios. Now, I've done a lot of research on dividend stocks in the past. And here's my best guess as to why this would all shake out this way. Based on the studies I've done, dividend paying stocks typically perform the best coming out of a down market. And if we flip back to the 20-year chart, well, here we had two different market crashes during this 20-year time period. We had the dot-com crash and we had the Great Recession. So the fact that dividend-paying stocks would perform so much better over the 20-year period makes a lot of sense. Now, if we shorten up this time period to 5 years again, well, here's my humble opinion of how this could happen. Specifically, the 0% or the blue bar being near the top. And to me, this actually makes a lot of sense. See, when I first started doing my research, well, I wasn't sure if dividend stocks were actually going to be able to outperform non-dividend paying stocks. The primary reason was that I believed that a dividend paying stock is essentially turning over cash to the investors that they can no longer use to grow their business. That's the reason Warren Buffett's Berkshire Hathaway doesn't pay a dividend. Why give that money to his investors when he could use that money and grow the company at an above average rate? And then, in theory, the price of the stock would follow, so the investors would essentially get the same thing, just at a better rate of return. So I figured that stocks that didn't pay dividends would be able to grow at a faster rate than dividend-paying stocks. And that theory seems to have held up fairly well. Now, what surprised me was that the second highest dividend-paying quartile did as well as it did in almost every time period we looked at. It made sense to me that the top-paying dividend quartile wouldn't be there because, again, in theory, they're paying out so much cash that it's going to slow their growth or at least their access to the capital that they once had they not paid that dividend. Okay, so now let's look at the dividend yield for each of the four categories and see how that shapes up. So my first thought is that look at how much higher the top dividend quartile is on a dividend yield perspective compared to the second to highest quartile. Now we know that the second highest quartile is the most interesting one in this whole bunch because it was at the top of all the performance charts. So how about we isolate that line by itself? So we can see that on the low end of the chart, this group was paying about 1.7%. And then recently it was paying right around the 2 to 2.5% range. Now this 2 to 2.5% is an average. And just so we're on the same page, the way that I did this whole thing is that I did an annual rebalance. So basically on December 31st of each year, I screened for what the companies would have been on that day, and then sorted them by yield and broke them into different categories. Then calculated their total return, and boom, just like that, we have performance per group. And if you're curious, I actually did this very test on the S&P 500 stocks a few days ago, and these are all the stocks that fell into the second highest quartile of dividend-paying stocks within the S&P 500 based on dividend yield. So as we could see, the lowest dividend yield of this entire group was just short of 2%, while the biggest dividend yield was just over 3%. So if you see any stocks on this list that you find interesting and you'd like to see me do a video review of that stock, do a video analysis, let me know in the comments below. So that is the truth about dividends. And although stocks that pay dividends are not a free lunch because the price of that stock is reduced automatically it's adjusted to reflect the amount of the dividends. But because so many investors love dividends, well, essentially dividend paying stocks tend to outperform non-dividend paying stocks. And if we focus on stocks that pay a reasonable dividend yield, not too high, not too low, then it's likely that those dividend paying stocks will continue to perform well. They'll continue to have enough capital to grow their business while simultaneously paying out a decent dividend yield. So if you found this video interesting, don't forget to hit the subscribe button, hit the thumbs up. Thank you for sticking with me all the way to the end of the video. Please, any comments, any thoughts you have, post them in the comments below. I'm very curious to see what everybody thinks of this concept in general. Thank you, and I'll see you in the next video.